So you have started investing, or you want to start investing, but you want to make sure that you are starting on the right track, because you know that if you make a mistake, it can cost you money. For example, people who started investing in 2025 and panicked and took their money out due to all the tariff announcements, they did not make that money back. The people who went heavy into Bitcoin after the 2024 election, they also lost money, and so far have not made that money back if they were short-term investors. I have 5 steps that you should go through, and we're going to start from the bottom and work our way up. The first one is build a good baseline. You want a foundation. What I mean by that, and this is going to seem basic and repetitive first, and then we'll get more into the advanced things, but it is building that savings. Now, the difference here is this. Most people have been saying 3 to 6 months. It has always been the guideline. I am thinking, especially going into 2026, you want to start to build that out and maybe go closer to 12 months. Now, I'm going to tell you now, you don't have to wait to get 12 months in cash before investing. I think that is detrimental. I think you can work towards that and just have that in the background automated. For example, you can say, look, I have X amount in savings right now. It's going to take me another year. It can take me a year and a half to get that 12-month savings. So I'm going to do this. Set $300 a month that goes from the 1st and the 15th. That's what's going to happen. Set it, automate it, and let that run in the background. Boom. Your foundation is set, and that is going to build for you in the background. You're done. All right? That's what you need to do. Build that foundation. So see what it's going to take you to build that foundation first. The reason why you need that is, number one, if something happens, you don't want to have to pull from your investments. The most powerful thing about investing is, yes, it can grow, it can compound. It's not going to matter if it grows and compounds if you have to pull from it. There are so many people say, oh, well, I invested in NVIDIA, back in 2016, back in 2018, and now it's up 22,000%. Cool. But you had to use it because you had car problems, or you had to use it because there was a layoff or something like that. Okay, that happened. But if your emergency savings was large enough, if that base was large enough, you wouldn't have had to touch it, and you would have that money today. That is why you want to have it, and that's why you want to have it large enough that it can protect you to allow that money to continue to grow. Now, here's where we get into the investing part of it. Now we have that base. What do we actually invest in for 2026? There are different ways that you can arrange this. So number one, you definitely want to have some index funds. However, you want to invest in different index funds than perhaps you may have been used to. You're going to have your classic US index funds. That's something like VTI or VOO. For those that don't know, those are stock symbols for the US stock market. So VOO is the primary index fund for the S&P 500, the 500 largest companies in the US. Very good, strong index fund. It's from Vanguard. Cool. VTI is the U.S. total stock market. One or the other should work for you. I prefer VTI because that's the total stock market. It's essentially all the stocks in the U.S. Most people, now a lot of people online, they just say, hey, just get one of those. That's all you need. You don't need nothing else. No. 2025, that's not all you needed, if you ask me. And in 2026, I don't think that's all you need either. You need some level of international fund. For example, VKG is a European index fund. That one in 2026, at the time I'm doing this video, is up 31%. All that we learned in 2025 shows us that you want to diversify outside of the US. Now, a question for you, right? For you and how you want to invest and how you feel about investing in other nations, how much should you have between the US and Europe and the US and other countries? That is definitely going to depend. Now, I can help you figure that out. You can go to buildingbread.com/callkev. I've already started to fill up my calendar for 2026. I've already got 15 people just like you trying to figure out how to start investing for 2026 in January alone. So my calendar is filling up, but we're already sitting down and saying, hey, what is it that we need to do and how to invest for 2026 and also take care of your entire financial picture. Those calls are free. Sign up at buildingbread.com/callkev. But again, the question is what combination? But the biggest thing is what combination is going to work for you. And most importantly, you want to invest and diversify outside of just pick a U.S. index fund and call it a day. For context, the time I'm doing this video, the U.S. stock market was up almost 15, almost 16%. Europe by itself did more than double. South Korea, as of last week, was up 70%. So there is way more money outside the US that may continue in 2026. Then you have the question, this is moving up just another level, then there's a question of how much alternative investments do you want to add to your portfolio? Now for me, this is like the tippy top of that pyramid, if you will. Is it going to be just 5% of Bitcoin? How much gold? Gold hit an all-time high in 2025. Is that going to continue into 2026? How much of that do you personally believe in, and how much of that do you want to risk and put into your portfolio? There are also gold ETFs that you can buy and easily include in your portfolio too if you want some exposure to that as well. But that is something that is worth considering. But again, the question is, do you want to do 10%? Do you want to do 15? I would argue more than 15 is quite aggressive, but that is an option too, an option for you. But between gold and Bitcoin, I do think they play a role. They absolutely play a role, but how much, right? If you only have 100%, you know you want to have some international, you absolutely want to have some in the US. And then what's left for gold? What is left for Bitcoin? Even though Bitcoin is down now, I still think there should be some room left in that pie. For me, it ain't more than 5%. For you, the answer may be a bit different. That is how you want to compose that portfolio. But let's say you want a different type of mix. What about individual stocks? Let's say, hey, I want some of those ETFs, but I don't want gold. I want some stocks I can substitute there instead. If you don't want the gold and you want to put in some stocks, you could absolutely do that as well. What stocks are out there? Obviously, I think tech, most people say that, tech and AI, those stocks are going to continue to do well. That is where a lot of the momentum is. For 2026, currently, you still have some financial stocks that you want to keep an eye on. Right now, it's also manufacturing stocks that are the place where rotation, right? I put that in air quotes, where rotation is happening. Rotation meaning money flowing out of one sector, moving into another sector. Why do I say that? A company like Caterpillar, the stock symbol there is CAT. Caterpillar is up close to 60% in the last year. That is just one of many companies in that space that is doing quite well and may continue to do so in 2026. So pay attention to that category of stocks, and the reason why you want to do that is because it gives you a broader set of companies to invest in and gives you a bit more diversification. I've said that word a few times. Diversification is putting your eggs in different baskets so that it affords you the ability to be wrong without crashing your entire portfolio. The reason why I say that is because let's say that you have a lot of money in AI, and we all do, whether you knowingly have it or not. If you are invested in index funds, especially in the US, 40% of that index fund is run by AI. That is a fact, okay? If this is an AI bubble and it pops in 2026, I'm not sure if that's going to be the case, but if it does, I say, hey, I've got 5% of my money in Caterpillar, and I've got some other manufacturing stocks, and I've got some finance stocks, I'm not doomed. Right, that is going to be able, hopefully, that should be able to protect me to a degree, and perhaps those stocks continue to do well, and that's not going to just up in my entire portfolio. So that is the basis for having those things kind of even out. So pay attention to that as well. It's also why you might want to have some gold, and maybe why you want to have some of that Bitcoin too. Now that you have those different types of investments and options for you, then we move into the accounts. What type of accounts can you invest in, or should you invest in? Most people have the 401ks and the 403bs. The 403bs, those are the ones for like teachers, nonprofits, 401ks, people who work for a regular employer. We're gonna set those aside. Those are extremely important, and you should be using those. For those who may be asking, I like to have 12 to 15% of my salary going there. But again, we're setting those aside. There are 3 levels. You don't have to open all of these today. Okay, but if you got time and you off of work, go ahead and do this, all right? The reason is these 3 levels are the things that you want. You want a taxable bucket, a tax-free bucket, and a tax-deferred bucket. What do I mean by that? Your taxable bucket, these are the accounts where you have no limit on how much money you can put in and no limit on how much money you can take out. These are your regular brokerage accounts. You can put in as much money as you want, you can invest in whatever, and then you can take the money out. Now, you have to pay taxes on these every single year. That is important because if I were to retire early or if I wanted to buy a house, I can sell that and there's no penalty to do that. So that is something that's important. Then I have my tax deferred bucket. Tax deferred meaning I ain't got to pay no taxes right now. Now that includes a regular 401k. That also includes a traditional IRA. I'm not paying taxes today. It's going to lower my taxes today and it's going to grow tax free. That is what I want that for. It's a regular traditional IRA. Then I have my tax-free bucket, and that is my Roth. Now I'm paying taxes now, right? And then at 59 and a half, I can withdraw that money tax-free. That is how that works. Now later down the line, we can talk about all, how these buckets work together, but that's the beauty of it. I can withdraw some now. I can wait till that money continues to grow. I can use the tax deferred and then use the tax free and have that tax diversification. There's that word there again. But that is how all of these things can work, and that's how we set up everything for 2026. Now, this was a list of things. I would argue that you want to have written those things out. You can go back and replay this video again and again as you write these things out, or you can also schedule a call and we can go over these things specifically for you. But if you want to learn more about the stock market, how it works, what to invest in, and what strategies work best, you want to check out these videos right here.